Hi, this is Richard Chamberlain, and welcome back to the Protecting Your Family's Future podcast. This is episode number 99. Today, we're going to be looking at crisis planning in long term care situations. Now, last week, I was talking about how to proactively protect your assets. And as a reminder, proactive planning is before the 5 year window starts to come into play, before someone is in the nursing home or before someone is about to go into a nursing home, somewhere in the possible distant future. And we need to start doing this planning now so that the 5 year window does not come into play. At the end of last week's episode, I said that even though proactive planning is best, it is still possible to protect assets if someone is already in a nursing home or they are about to go into a nursing home. And today we're going to talk about that in more detail. My partner, Tim Alley, is here with us again. Welcome back, Tim.
Thank you, Richard. It's good to be back.
And Tim, we're going to be talking today about how to protect assets in what we've described as a crisis situation. Now, what can you tell us about long-term care crisis planning?
Well, it's a lot more complicated than proactive planning, and it's usually not possible to protect quite as much of a person's assets as can be done under a proactive plan. But it is possible to protect some, just not as much under a proactive plan.
So, what makes it more complicated?
There's many things that make it more complicated, but one of the primary reasons is that there are a lot more rules about the use and gifting of assets. There's also the fact that the person needing the care usually can't help in the process of protecting the assets, so powers of attorney are needed. And when dealing with Medicaid income qualifications, asset management rules, paying for care, moving assets from countable to uncountable, and doing some other things. All of this while dealing with managing a person's care, it gets very complicated. And in addition, you're trying to do this under the rules for when the 5 year look back rule is in effect. The 5 year rule being that assets can't be transferred for less than market value within the 5 year period of time. So during that period of time, those rules come into play and get more complicated.
So you know that whatever is done is going to be very highly scrutinized in the Medicaid application process. Is that what you mean?
Correct.
Okay.
Correct.
So what kind of planning tools are available to do this kind of planning?
Uh, there are planning tools of care contracts, irrevocable trusts, Medicaid compliant annuities, prepaid funeral plans. You can convert IRAs to payout status. You can use rental agreements, and there are other tools as well, but those are kind of the primary tools that a lot of times you use.
All right. So we've talked at length about irrevocable trusts already, and if any of our listeners haven't heard about those, I encourage you to go back and listen to those irrevocable trust episodes. But can you give us more information about what a care contract is?
Sure. Let's first set up a little bit of an example so I can relate this to something specific. Let's say that there's a single woman who has $200,000 in countable assets and earns about $2,700 a month in income from a Social Security and a pension. In order for her to qualify for Medicaid benefits, her assets need to be spent down to less than $2,000, and her income needs to be spent on her care except for $50. So if she's going to use a care contract, she can set up the care contract so that her family can assist her while staying at home, and she can actually pay family members a certain amount every month to help her with things like getting to doctor's appointments, going grocery shopping, doing cleaning, maintenance around the home, um, assisting with medications, things of that nature, to allow her to be able to stay at home. In the care contract, they might set up so that the payment is, say, $3,000 a month. And if they do that for 2 years, then they're able to move about $72,000 of the 200,000 over to the family without causing difficulties with that transfer rule under the 5-year look back portion.
So that 5-year rule really only penalizes transfers for less than value, but this care contract is you're paying someone for services. So it's not a gift at all. Is that right?
Correct. You're able to get around the gifting rule by paying somebody for services and doing it in a way that is for value based on what some of the current reasonable payments would be.
Okay. Can you do a care contract if someone is already in a nursing home? You were talking about so that they can stay at home, but what about if they're already in a nursing home?
You can, it gets a little more complicated at that point in time, but you can, at that point in time, there's just less that's able to be transferred. And so a lot of times the care contracts are used when somebody is at home and needs a lot more assistance, and the family wants to try to keep them home for as long as possible.
Okay. All right. Now, you also mentioned a Medicaid compliant annuity. What is that?
Medicaid compliant annuities are typically used in conjunction with other tools, like an irrevocable trust. In the example above, if the woman were to have that $200,000 of countable assets, she could transfer $100,000 to an irrevocable trust and use the rest to set up a Medicaid compliant annuity. The annuity has to pay out over her lifetime, or a shorter period of time. And so the annuity would basically pay out a set amount each month to pay for the cost of care. And the annuity would be set up for a specific number of months based on the amount of assets transferred to the trust. So if the gift to the trust created a penalty of 14 months because $100,000 transferred to the trust as a gift, and based on the rules, that would be about 14 months of penalty, the annuity has to pay out for 14 months to cover that penalty period. So she could be in the nursing home. At the end of that 14 months, the funds that are in the trust are protected, and Medicaid would start paying for the care in the nursing home.
Okay, so we're using a combination of tools in that case to kind of run out the penalty period. Is that a fair way of saying it?
Correct. Yep.
Okay, great. So I can see, yeah, it's a lot more complicated, but it certainly is doable. Now, as we're wrapping up our series on long-term care planning, if you can give us one takeaway, one most important thing to remember about planning for protecting assets from long-term care, what would that one takeaway be?
The biggest takeaway that I would say is to start the planning as early as possible. If you're an individual that's concerned about long-term care, come in and let's look at the proactive plans and when and how that might work for you. If there's somebody that is needing care, they're not able to get out as much, let's come in and start having a conversation if we can set up the care contract or do some other things to start the process and maybe get outside the 5-year window. If we're inside the 5-year window, there are some other tools. So starting the planning as early as possible is really the key to all of this.
Great, good to know. Thank you. So that's it for today. If you have any questions, anybody who's listening or watching has any questions about how to protect their assets from long-term care costs or to protect assets of a loved one, if you're in Ohio or in Michigan, reach out to us and we can help you. I hope that's helpful for you today, and we'll see you again next week. Thanks.